Inventory valuation methods are a cornerstone of business finance, and understanding them is crucial for anyone involved in managing a company's assets. So, let's dive into what inventory valuation is, why it's important, the various methods available, and how to choose the right one for your business. First things first, what is inventory valuation? Simply put, it's the process of estimating the fair market value of a company's inventory. This valuation is not just a number on a balance sheet. It influences decision making about purchasing, pricing, and selling products. Accurate inventory valuation ensures that a business can track its assets effectively, forecast future needs, and budget wisely. If a company miscalculates its inventory value, it may end up making poor financial decisions that could lead to decreased profits or even bankruptcy. Now, why is inventory valuation so important? For starters, it allows businesses to account for their assets accurately. Imagine a scenario where a business has a significant amount of unsold inventory that is overvalued on the books. If that's the case, the company might think it has more capital than it actually does, leading to overspending in other areas. Accurate inventory valuation is also essential for determining the pricing of products and services. If a business doesn't know the true cost of its inventory, it risks underpricing or overpricing its offerings, which can directly affect sales and profitability. Moreover, inventory valuation helps businesses avoid costly mistakes. Overspending on inventory can lead to increased debt, while underspending can result in stock shortages and lost sales opportunities. A well-structured inventory valuation system can guide managers in making informed decisions about production and resource allocation, ultimately saving money and increasing efficiency. Another key point is that inventory valuation is vital for measuring business performance and profitability. By understanding the value of their inventory, businesses can identify which products are performing well and which may need to be discontinued. This insight allows companies to focus their resources on more profitable offerings, enhancing overall profitability. So, what are the objectives of inventory valuation? One primary objective is to determine the fair value of a company's assets. This involves analyzing each inventory item and assessing its current market price or replacement cost. Accurate inventory valuation is crucial for financial reporting and tax calculations, ensuring that businesses maximize profits while minimizing costs. Another objective is to ensure that a company has sufficient capital. This means calculating the total cost of all inventories on hand and ensuring it doesn't exceed the current market value. By evaluating inventory turnover ratios, businesses can identify areas where they need to adjust spending or reduce costs to remain competitive. Now, let's explore the two main categories of inventory valuation methods, physical and financial. Physical methods focus on analyzing existing assets, while financial methods rely on estimates of future cash inflows and outflows related to those assets. When using either method, factors like the age, condition, size, and price of the evaluated assets must be considered. There are several inventory valuation methods that businesses can use, each with its own advantages and drawbacks. The most common methods include first in, first out, last in, first out, weighted average cost, specific identification method, and the retail inventory method. Let's start with FIFO. This method assumes that the oldest items in inventory are sold first. It's a straightforward approach that often results in higher profits during periods of inflation since it uses the cost of older, cheaper inventory for calculating the cost of goods sold. However, FIFO can lead to a lower balance sheet value for ending inventory as it leaves the newer, potentially more expensive items still unsold. On the flip side, we have LIFO, which assumes that the most recently purchased items are sold first. This method can be beneficial during inflationary periods, as it matches the higher cost of newer inventory against current revenues, potentially resulting in lower taxable income. However, LIFO can lead to outdated inventory values on the balance sheet and may not reflect the actual flow of goods. Next up is the weighted average cost method, which averages the cost of all inventory items to determine a single cost per unit. This method is particularly useful for businesses with homogeneous products. While it simplifies inventory management and pricing, it can mask fluctuations in costs and may not reflect current market conditions accurately. Then we have the specific identification method, which tracks the actual cost of each specific item in inventory. This method is ideal for businesses with unique or high-value items, such as jewelry or artwork. While it provides precise tracking and valuation, it can be time-consuming and cumbersome to implement for larger inventories. Lastly, there's the retail inventory method, which estimates the value of inventory based on the retail price of goods. This method is often used by retailers and can be a quick way to assess inventory value, but it may not always provide an accurate reflection of actual costs. Now, how do you calculate inventory value for each method? For FIFO, you take the cost of your oldest inventory and multiply it by the quantity sold. For LIFO, you do the opposite, using the cost of your most recent inventory. The weighted average cost method requires you to divide the total cost of all units by the total number of units available for sale. Specific identification involves tracking the cost of each individual item. Choosing the right inventory valuation method for your business can feel overwhelming, but it doesn't have to be. Start by analyzing your business operations. Consider factors like production speed, cost structure, and customer demand. Consulting with inventory management experts can provide valuable insights tailored to your specific situation. Before fully committing to a new method, run a test to see how it performs in practice. Once you've implemented a method, continuously monitor its performance. Keep an eye on customer satisfaction, operational efficiency, and cost savings to ensure it remains effective. In conclusion, inventory valuation methods are essential tools for any business. They not only help in accurately assessing the value of assets, but also play a crucial role in decision making, financial reporting, and ultimately the profitability of a business. Understanding the various methods available and their implications can empower business owners and managers to make informed choices that drive success. So, take the time to evaluate your inventory valuation practices and ensure they align with your business goals. Your bottom line will thank you for it,